Our April edition focuses on the impact of market volatility on real estate. Throughout March, the news from Ukraine has been disturbing and relentless. As a human, my thoughts go out to all those suffering in that region, and I hope that peace will soon return to that part of the world. The signals we're seeing at the end of the month are certainly providing glimmers of hope. As a real estate investor, throughout the course of March, I've been paying attention to the dramatic economic gyrations accompanying the war headlines. March saw higher interest rates, higher inflation, waves of risk-off and risk-on market sentiment, yield curve changes, and rising commodity prices. This volatility is the focus of our April macro deck note, and there are numerous slides detailing these market moves. In March, interest rates generally moved higher after initial safe haven effect when sovereign yields fell following the invasion. Stock markets also fell at first, but later rebounded and ended March up. Elevated inflation indicators continued to be reported from around the world, and the concern that higher inflation will remain persistent became more widespread. In March, the U.S. Federal Reserve became the 11th G20 central bank to raise interest rates since the COVID pandemic. The Fed has been communicating direction well ahead of action, and the current signal is the March rate hike will be the first of several in the coming months. Higher interest rates are a concern to real estate investors because real estate is very dependent on borrowing. In 2020, economic distress was accompanied by falling interest rates, and the net result was higher real estate values, especially in 2021. The question now is if higher interest rates will lead to lower real estate values in 2022. There is no global answer to this question. The outlook for each market, sector, and property is impacted by secular trends, economic growth, ability to raise rents, and buyers' access to leverage. Consideration of all of these factors, alongside interest rate changes, is going to determine the outlook for values. In some cases, we expect NOI growth will outweigh negative impact from higher rates, while in other cases, the balance will go the other way. Inflation's impact on real estate is also nuanced. It has been decades since developed economies have seen a high inflation rate. Yet, the case for real estate in a diversified portfolio continued to include its inflation hedging ability. The increase in real estate allocations over the last 2 decades may have been more about risk-adjusted returns than inflation hedging. But now that we have elevated inflation, will real estate deliver on its hedge of inflation promise? One challenge of demonstrating that real estate is an inflation hedge is real estate data from the late 1970s and early 1980s when inflation was last elevated is quite limited. 2021 provides some new data with regards to elevated inflation and the impact of values. So how much of an inflation hedge was real estate last year? Well, it depends. It really looks like the critical element for real estate to be an inflation hedge is the landlord's ability to raise rents. In 2021, there was landlord pricing power in residential and industrial sectors in many markets, while that was lacking in office and retail in many markets. And looking at returns relative to inflation just based on 2021, it looks like real estate was a great inflation hedge for residential and industrial and a weak hedge in retail and office. So the conclusion for now is that while the theoretical case of real estate as an inflation hedge focuses on lease terms and expense burdens, the most important element is simply the power that landlords have to raise rents. We hope you will look through the slides and the snapshots of the March market changes and find them useful. Thank you for your time.